Here at his first forum, I am pleased to introduce Director William Birdthistle, who recently joined the Commission as the Director of the Division of Investment Management. A timely day for you to be joining us when we are looking at some of the issues facing funds. William, I look forward to your remarks, and I'll turn the microphone over to you.
Thank you very much, Martha, for the kind introduction and, of course, for the invitation to speak today on the recent work that the Division of Investment Management has been doing. Let me first begin, if I may, with the customary disclaimer that my remarks today are my own and they don't necessarily reflect the view of the Commission, the Commissioners, or the SEC staff. Let me also offer a quick word of congratulations to you, Director Miller, who has lived some of the experience of small businesses and startups and entrepreneurs everywhere by serving as the founding director of the Office of the Advocate for Small Business Capital Formation. Congratulations to you. I'd also like to note that soon after I graduated from law school, which was quite a while ago, I myself spent some time at a small startup. Such was the spirit of the age. The idea was a good one, I thought, but we had the misfortune to launch a few months before the bursting of the dot-com bubble. Needless to say, capital formation was a constant concern for us. That experience, which involved holding a little sweat equity, also taught me more about securities regulation than anything else before or since. Section 504 of Regulation D was never far from our minds. But that was a long time ago, and now I am, as you said, the new member of the Division of Investment Management. And the focus of our work is, of course, primarily upon investment advisors and investment companies, or as we know them more colloquially, investment funds. Funds include not just the $30 trillion in registered investment companies, but another $18 trillion in gross asset value held in private funds. Those funds include hedge funds and private equity funds, but perhaps most pertinently for many small businesses and our conversation today, venture capital funds. Venture capital has long been a remarkable engine for job creation and research and development for the entire American economy. Not every small business receives financing from VC funds, of course. Indeed, the startup where I worked never did, alas. But the topic is probably the closest point of connection between the Division of Investment Management and today's Small Business Forum topic. So allow me to take a moment, if I could, to discuss some recently proposed reforms that concern investment advisors and private funds. This past February, the Commission proposed new rules for private fund advisors, including, of course, advisors of venture capital funds. These important reforms are designed to protect private fund investors. If investors in funds, as Commissioner Lee just alluded, have greater confidence in those instruments, they may be more willing in turn to bring their capital into those funds, which in turn can bring more capital to small businesses. The proposed new rules and amendments to the Investment Advisors Act will address key areas in the private fund space that have been ripe for reform for a while now. If adopted, the proposal will provide an important check on advisor behavior and would, we hope, improve the quality of information provided to fund investors. There's a couple of different components, and I'll just mention a few of them briefly. First, the proposal will require private fund advisors to provide investors with quarterly statements that detail information about the private fund performance, fees, and expenses. Those statements will allow investors to have better information and to be able to compare investments. Registered private fund advisors will also be required to obtain an annual audit, and that audit is required to protect fund advisors and investors from misappropriation of fund assets, and would, we hope, serve as a check against the advisor's valuation of the private fund's assets. The proposal also addresses advisor-led secondary transactions, and the idea behind that measure is to address another area of potential conflicts of interest where an advisor may stand to profit at the expense of private fund investors. Another key element of the proposal is the prohibition of certain practices that are contrary to the public interest and to the protection of investors. Chief among those would be a prohibition on all private fund advisors from charging certain private fees to the funds, such as accelerated monitoring fees, fees associated with examination or investigation of the advisor, and fees or expenses related to portfolio investments on a non-pro rata basis. Each of those practices incentivizes an advisor to place its interest ahead of the private fund's interest, and prohibiting the practices reduces the risk of fraud and investor harm created by that conflict of interest. Lastly, the proposal also prohibits all private fund advisors from providing preferential treatment that has a material negative effect on other investors in the fund. Again, we look forward to receiving and reviewing comments from any and all of you and to engaging with the public more broadly on the important issues raised by that proposal. Thank you again for the invitation to speak with you today on the recent work of the Division of Investment Management. I would also like to use this opportunity to thank all of the members of the staff of Investment Management who have worked very hard on this proposal, as well as several others, to make those proposals come to the Commission in a timely fashion with well thought and well-researched ideas. With that, I trust you'll enjoy the rest of your forum, and I'll now turn the presentation back to Martha. Thank you, Martha.